Sometimes precious metals stocks are at a significant premium to the physical, and sometimes they're at a significant discount to the physical. At the present time, I think that mining stocks, gold, silver, platinum, are at a discount to the underlying physical precious metal. So now is the time to buy essentially precious metal stocks, some gold shares, and I think purely from a portfolio management point of view, from a performance point of view, now is a good time to buy mining stocks.
Marc Faber, renowned editor and publisher of the Gloom, Boom, and AMP Doom report, recommends a strategic shift toward precious metal stocks, specifically gold, silver, and platinum. With inflation on the horizon, Faber sees the current moment as a prime opportunity to invest in these assets, given their discounted prices relative to physical metals. He believes mining stocks in these metals are undervalued, indicating a favorable time for potential investment. The outlook for mining stocks, particularly in the gold sector, appears optimistic, with the Zacks Mining, gold industry group, ranking in the top 32% among approximately 250 industries. This favorable ranking suggests an anticipated outperformance relative to the broader market in the next 3 to 6 months. Farber maintains that despite the ascent in gold prices, these metals remain a robust store of value. Faber contends that their enduring appeal is fortified by the indispensable role of central banks in the perpetual act of money printing. The recent surge in gold prices further supports Faber's perspective. Gold has climbed for the 4th consecutive session, reaching a more than 6-month high. This upward movement is attributed to a weakening dollar and the prevailing sentiment that the U.S. Federal Reserve has concluded its interest rate hikes. Notably, spot gold gained 1.4%, reaching $2,041.55 per ounce. Faber's investment strategy involves a consistent monthly purchase of gold, comprising approximately 25% of his diversified asset allocation. This allocation places precious metals alongside real estate, stocks, bonds, and cash, reflecting a comprehensive and well-rounded investment philosophy. Before diving into Marc Faber's insightful interview, subscribe to our channel and give this video a big thumbs up.
You know, the big diversified companies, they do exploration or they buy exploration companies and they produce gold and silver. So I have both. But from a portfolio point of view, I believe that financial institutions and the mindset of portfolio managers at Fidelity and all these large financial institutions is against gold, because gold is honest money. And say if we measure stocks against gold over longer periods of time, sometimes stocks underperform gold. So the portfolio managers don't like to talk too much about gold. But if they will be forced to move into the gold sector, they'll buy the big ones because of the liquidity. Small stocks don't have enough liquidity for CalPERS and for Vanguard and for BlackRock and so forth. So they'll buy Barrick and Newmont and so forth. I've been advising investors to own gold and other precious metals, silver, platinum, for the last 40 years. And I buy continuously every month some gold. And in my asset allocation, gold is a side of real estate, stocks, bonds and cash. Gold and precious metals, physical would be about 25%. So I have a large exposure to precious metals. I don't think that gold today is as cheap as it was in 1970 when it was at $35 an ounce. This I want to point out. I'm a Swiss. I live here. I grew up here. I lived since 1970 outside Switzerland, but I come back. And so I can tell what the price level was, say, 50 years ago and what it is today. So let's say it's about up 10 times the price level. Gold, in the meantime, is up much more, from $35 an ounce to close to $2,000 an ounce. So gold has actually been a good store of value. And when I look at the commodities complex, say, oil would be cheaper than gold, or wheat, corn, soybeans, sugar, even coffee is much cheaper than gold. But I think in consideration of central banks whose function in the long run is to print money. We never forget that. A central bank exists to print money. In view of that, I think that gold and other precious metals are still a good investment from a long-term perspective and also from a safety aspect. Secondly, there are times when paper is more expensive than the physical. Say in real estate stocks, they swing more than the value of the real estate. In precious metals, it's the same. Sometimes precious metals stocks are at a significant premium to the physical. And sometimes they're at a significant discount to the physical. At the present time, I think that mining stocks, gold, silver, platinum, are at a discount to the underlying physical precious metal. So now is the time to buy essentially precious metal stocks.
Faber identifies major peaks in commodity prices around 1980, followed closely by a pinnacle in interest rates in 1981. This initiated a prolonged phase of declining structures in both inflation and interest rates, influenced by central bank interventions. Faber highlights clear patterns and cycles in inflation, interest rates, and commodity prices during this particular time frame. A pivotal moment in this historical context was the peak in gold prices at $677 per ounce in January 1980, signaling a staggering 97% loss in U.S. dollar purchasing power relative to its original fixed price of $20.67 per ounce. However, by June 1982, gold's valuation had receded to less than $300 per ounce. Faber underscores the unrealistic expectations of infinitely higher gold prices in 1980, highlighting the subsequent market correction shortly after. In 1980, inflation in the U.S. soared to 14% during the same period, coinciding with an astonishing 17% Fed funds rate by March of that year. Drawing from this historical perspective, Faber illuminates his investment strategy, revealing that a substantial portion of his precious metal holdings resides in physical assets. He underscores the foundational strength he perceives in physical assets. However, he also discloses a strategic diversification with some holdings in gold shares, aligning with a nuanced approach to portfolio management. Let's get back to the interview.
The key is that we have long-term cycles. And we have cycles of accelerating inflation and then decelerating inflation or disinflation or even deflation. And we have trends and cycles of rising interest rates and falling interest rates and rising commodity prices and falling commodity prices. So it all varies, but my sense is that we had a peak in commodity prices in 1980 and the peak in interest rates in 81. Thereafter, we had a declining structure of both inflation and interest rates, partly artificially steered by central banks, but we made a major low in, say, May, August 2000. And where the 10 years treasury yielded less than 0.6%. We went down to 0.57%. And now we are in an uptrend in inflation and uptrend in interest rates that will be interrupted from time to time by counter-trend moves, such as we had in the 1970s. But the long-term trend, next 20, 30 years, is for inflation to accelerate and for interest rates to move up. Although in the next 6 months, I think that interest rates will go down. So we have to distinguish between the short-term trend and the long-term trend. My observation of in my life as an investor and as a social observer and economist is that you should never buy anything where the mood is very optimistic, because the expectations are exceeding the reality. On the other hand, we talk about gloom and doom. Emerging markets are in a very negative sentiment phase, especially China and Hong Kong. So I would say there is an opportunity. Say in properties in Hong Kong, you can buy the best property companies at a discount of 60% to asset value. The asset value will go down, but not by 60% in my view. The same with gold shares. I think especially the South Africans are very cheap. So myself, I hold most of my precious metal portfolio in physical. And I can explain later on why. But I also have some gold shares, and I think purely from a portfolio management point of view, from a performance point of view, now is a good time to buy mining stocks. Well, I think that asset markets are not in a favorable position because financial markets, they will be plagued by, in the corporate sector, I mean, stock markets will be plagued by declining corporate earnings. And in terms of currencies, I think the dollar will go down, precious metals will rise, the bond market will rally for a while. Say, if you look at TLT, the high was 170, it's now at 87, 86. I think we can rally to around 110. So investors should do well by being out of the US dollar, in my view. And emerging markets, they have never been this low since 1973 vis-a-vis the developed markets. So I would look at investing some money in emerging economies.
How might these historical patterns and Faber's current investment philosophy guide individual investors in navigating today's economic landscape and potential market shifts? What lessons can be drawn from this historical correction? And how might it inform our understanding of today's market dynamics? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.